Good afternoon, everyone, and on behalf of the Commonwealth Bank and our community, welcome to today's webinar with Professor David Gilchrist, co-convener, Not-for-Profits UWA at the University of Western Australia, and co-author of the Not-for-Profit Balance Sheet, a resource for directors and CEOs. We're also joined by Lachlan Pollock, manager of the Festival of Community Directors at our community, who will be facilitating questions at the end of today's presentation. I'm Fiona McCauley, Senior Manager, Schools and Not-for-Profit Sector Banking here at CommBank. To start, I'd like to acknowledge the traditional custodians of the land where everyone is joining us from for today's webcast and pay my respects to elders past, present and emerging. Before we get underway, you'll have the opportunity to send in questions throughout the webinar, and you should be able to see a section to post your questions on the toolbar on the right-hand side of your screen. There'll also be a survey at the end of today's presentation, which will help us better tailor future presentations to meet your needs. And of course, no presentation from the bank would be complete without a disclaimer, which should be on your screens now. Well, we've got a lot to get through in this session, so without further ado, a very warm welcome and over to you, David.
Thank you very much for that warm welcome, and I too would like to acknowledge particularly the Whadjuk people of the Noongar Nation, those elders past, present and emerging who have been custodians of the land from which I am presenting today, but to also acknowledge all of those First Nations people from around the country from where you might be sitting and participating in this seminar. I'm very keen to and very pleased to be able to present this seminar today, our second in the series, looking at the not-for-profit balance sheet. And particularly, I guess there's two things I'd say about that. Number one is to reiterate the importance of being able to get back to us with feedback in terms of what's in this particular seminar, but also what kinds of topics you might find useful for future seminars. Helps us very much in terms of making sure we're doing some things to help the sector. Secondly, I think it's really important to remember that when we're looking at the not-for-profit balance sheet, we always look at it in the context of the broader financial governance process. And so the discussion today, which is aimed at the not-for-profit balance sheet, budgeting the balance sheet for short, medium and long term, is really aimed at two fundamental aspects. One is ensuring sustainability, and I'll talk about that shortly, but the second is also ensuring that you have strong governance over your organisation and are able to control your organisation effectively. Okay, let's get into the material. So first and foremost, I'd like to thank CommBank for their support and also our communities for their support in terms of helping us to put together the tool itself and also to present these seminars. I'd like to thank the sector based on the input that we've had from previous seminars, but also more broadly, the sector's continuous support for the kinds of work that people like myself and others within academia and across the community do to try and bring these tools to you. And then finally, I'd like to acknowledge my colleague, Dr. Dane Etheridge at Curtin University, who helped us to develop this particular resource. In terms of the resource itself, you might recall that, in fact, it is the not-for-profit balance sheet, a resource for directors and CEOs. This is the cover of it, and it's been delivered to all those people who have registered as participants, but it's also available to on various websites. So if you don't have a copy of it and would like it, please make sure you make contact so that we can get that through to you and that you can use that for you and your board's and CEOs' edification going forward. What does the resource do? Well, I think it's important for us to just revisit quickly the purpose of this resource and to ensure that the presentation that I provide today is also understood in terms of what the audience is and what we're trying to achieve. Essentially, the resource does three things. Its intention is to describe the purpose, nature and governance of the balance sheet itself. And as I've said in previous webinars, the balance sheet has not often been the most important financial tool for a not-for-profit organisation for a raft of reasons historically, but increasingly the balance sheet is becoming absolutely critical, not only to maintaining sustainability today, but sustainability into the future. And so the purpose of today's discussion around budgeting for the balance sheet is really to help you to develop some tools designed to be able to forecast and perhaps also modify the balance sheet outcome for your organisation over time. This tool is also focused on those untrained in accounting, And so many of the concepts and discussions here, I hope, will bring some ideas to accountants and those people with a strong understanding of accounting technique. But by and large, the audience for this tool is really those people that don't have accounting training or accounting experience as part of their repertoire of capacities that they might bring to their not-for-profit organisation. The third thing, and a thing that I think is probably one of the most important aspects of this particular tool, is that it actually suggests some key focus questions for CEOs and boards, questions to ask about your organisation. Unfortunately, these tools and the discussion that I'm going to present today don't necessarily give you all the answers. They raise questions, though, for you to consider. And it's important that you take those questions back to your boards, that you have discussions around those questions, but you might also seek to provide or obtain advice in relation to those questions as well, to make sure that your organisation is going to be as sustainable as possible into the future. So at the end of the day, this is a starting point, but make sure you get that advice. What is the focus today then? Principally, the focus is around how we might understand our balance sheet better, and particularly in the context of the budget cycle. Not only the budget cycle though, but also the financial planning cycle associated with your organisation. Again, I'll talk to these ideas as we go through the presentation today, but essentially my focus is really around how we deliberately structure the balance sheet. So in other words, often the balance sheet is not considered in the context of budget processes because we're concerned about things like cash flow. We're concerned about how much income we might receive and what our expenses might be, particularly for the coming year. If we undertake any financial planning, we might also undertake that financial planning in the context of income and expenditure, not so much in the context of the balance sheet itself. So often, the balance sheet outcome from a planning perspective is perhaps best described as accidental or unintentional. And what I want to do is to really put into your minds the idea that, in fact, you need to perhaps start to deliberately structure the balance sheet in order for short, medium and long-term sustainability to be achievable in the context of your organisations. By deliberately structuring, I mean understanding your balance sheet, understanding the components of your balance sheet, and then being able to budget to be able to make those components as strong as possible. I guess in a very simplistic sense, this means trying to create more assets and less liabilities, but perhaps most importantly, understanding the nature of those assets and liabilities, and perhaps more importantly, when they will crystallize into cash. In other words, when your assets might turn into cash, so people like debtors and other arrangements that you might have, and when your liabilities have to be paid, in order that you are able to ensure that you've got resources on hand to be able to deliver on those outcomes. But the other aspect of structuring the balance sheet and being deliberate about that construction is in understanding what level of assets are required for the organisation, what kinds of assets are required, and perhaps most importantly, how those assets might be replaced or enhanced over time to ensure that the organisation retains its sustainability. So really the focus today is about trying to suggest some ideas and have a discussion around how you might deliberately structure your balance sheet, but in the context of course, maintaining solvency, maintaining sustainability, and maintaining an income statement or budget process that actually makes sense for your organisation. So at the end of the day then, the key objective out of all of this is to maintain sustainability. And as in many webinars associated with this particular tool, I've been keen to try and make sure that we are all on the same page as far as sustainability goes. I think this is important because when we talk finance particularly, a lot of people consider sustainability in the context of the survival of the corporation, that is the survival of your charity or not-for-profit organisation. That survival is really important, but it's most important in the context of the mission of the organisation and what your organisation is there to do. So my proposition to you is that an organisation is not sustainable just because it survives. An organisation is sustainable because it's able to provide the right services in the right quantity, at the right quality, at the right time. In other words, you're able to continue to pursue your mission And that is what represents a sustainable not-for-profit or charitable organisation to my mind. And therefore, if we take sustainability as being defined in accordance with my definition just discussed, then we need to take that definition into our conceptions around planning and budgeting for the balance sheet as well, of course. And so that means at the end of the day that we need to ensure that we have sufficient cash and an appropriate asset mix in the short, medium and long term in order to make sure that we're actually going to achieve the outcomes that we want to achieve in a sustainable way for our organisation. Okay, so what is the purpose of balance sheet budgeting then? First and foremost, balance sheet budgeting is not profit and loss budgeting or cash flow budgeting. It doesn't replace these two things. It's critical support part of the whole budgeting process for your organisation. So you need to continue obviously to undertake profit and loss budgeting and cash flow budgeting. And I guess most importantly, profit and loss budgeting and cash flow budgeting inform the balance sheet budget process, and the balance sheet budget process informs the profit and loss and cash flow budgeting processes. All of these things are necessary and intertwined. Importantly too, that it is focused on targeting the balance sheet structure, not allowing the balance sheet to fall out of the budget process. That means, as I said before, that we're really keen to make sure that we understand in the short, medium and longer terms what our balance sheet needs to consist of in order for us to be sustainable, but also perhaps also understanding what kinds of problems we might be building into the balance sheet by deferring liabilities or deferring payments that we need to make. A great example here is in the case of employee entitlements for leave and long service leave and so on, where we don't manage that leave very well. We don't force our staff to go on to leave, and therefore we build up a very sizable amount owing in the balance sheet. Focusing on targeting the balance sheet structure means that we not only inform what we want that balance sheet to look like over time, but it also informs things like policies around our leave management processes. So not only is balance sheet budgeting important for the financial budgeting process, it's important to inform our broader policy processes as well. By fall out of the budget process, I mean that we want to actively engage with the balance sheet and its structure and targets, rather than just simply having the balance sheet fall out as a result of our profit and loss and cash flow budgeting process. The other thing that's really important, of course, is that we're focused on the short, medium and long-term horizons. And of course, this is a critical aspect in the financial planning process, as opposed to necessarily in the budgeting process. So for the purposes of this presentation and for the tool, we essentially talk about budgeting as being the immediate 12-month budget process, that is what's going to happen over the next operating year, whereas for financial planning, we think in 3 to 5 year terms. So while this presentation is really about balance sheet budgeting, or is titled balance sheet budgeting, we're in fact trying to mix balance sheet budgeting with ideas around financial planning to look at the 3 to 5 year horizon as well. And of course, it's an element of the financial plan, as I said before. So the idea is that this would also support the strategic objectives. I guess the upshot on all of these things is that they are intertwined, and it starts with a strategic plan and moves down into the budgeting and financial planning process, so that budgets and financial plans support the strategic outcomes you're trying to achieve, as opposed to driving those strategic outcomes. In terms then of the elements of balance sheet budgeting, essentially I see that there are 3 fundamental elements divided into the short, mid and long term. In the short term, we're worried about things like cash flow, working capital, and I guess essentially solvency. In the mid-term, of course, we're worried about leave entitlements and depreciation estimates, all of those things that are going to help us understand what kind of problems we might be building into the balance sheet in the longer term, and what kind of exposure we might have in that mid-term. In the longer term, we're concerned about asset replacement, but also about being able to invest in our organisation to allow for training and change, including change in the areas of things like IT and service delivery types, service mix. All of those things need financial resources to be able to bring them into reality. And so at the end of the day, I think that sustainability relates to all of those three time elements and those essential components, if you like, in the context of this discussion. So if you are undertaking balance sheet budgeting or balance sheet financial planning, or considering that as part of your armoury of planning going forward, what are the key questions that you need to be asking? I think these are fairly straightforward, and probably many people in the audience would feel comfortable with the nature of these questions. But essentially, the first and foremost is, of course, will we have sufficient cash to maintain solvency throughout our financial planning period? The second question, which I think is an equally important question, is will we have sufficient cash to invest in change and replace assets? And then thirdly, of course, will we be able to meet all the obligations in the short, medium and longer term? Really, this is a synopsis or a summary of a number of comments that I've made up to this point in the context of this particular presentation. But what I would say about this is that you've got to start from these questions in order to be able to plan the balance sheet effectively. What do these questions do? Well, they do two things. One, they identify the key objectives that you might have at the top level in relation to the balance sheet, but they also provide you with propositions about how you might analyse your current balance sheet and where it's heading if you don't put in any mitigations, if you don't plan to be able to respond to those challenges. The final point, I think, is a really important point for balance sheets as well, particularly in the charity and not-for-profit sector, and that is, are we adding landmines to the balance sheet? Where we can defer payments, such deferral can be a useful financial tool to allow the organisation to maintain its sustainability and perhaps to use its cash resources for other elements of activity in the interim. But what you don't want is to be blindly building landmines into the balance sheet, that is subsequent payments at some point in the future, and I guess just simply taking the attitude, well, the future will take care of itself. I've already introduced the example of leave loading and leave liabilities, which often become landmines in balance sheets, not only because of the amount of time that's owed to people, but also because of the fact the older those leave liabilities become, the more expensive they are to you, because of course leave is paid at the current hourly rate, not at the hourly rate in which the leave was accrued. So the longer you leave it between accruing annual leave and paying annual leave, of course, the more costly it is to your organisation, and therefore you're building this landmine, you're building this problem into your balance sheet. So what are the elements of balance sheet budgeting? What are the things that we need to think about? In the short term, we need to think about working capital budgeting, and we need to think about cash flow budgeting. Clearly, balance sheet budgeting is an amalgam of a number of different budgeting processes that you'll probably already have in place in many organisations, and some may not feel that they need some of these components. However, the working capital budget and the cash flow budget are critical, of course, for that solvency and sustainability in the short term, but they also impact components of the balance sheet, and I'll come back to that idea shortly. In the medium term, of course, we're interested in things like employee entitlements and budgeting. So leave forecasting is a really important issue. Based on history, what have we done before, but also building around that policy discussion that I mentioned before. What kind of policy do we want to put in place, and how do we want to enforce that policy to ensure we hit our leave targets for our balance sheet going forward? And of course, the other component, major component, is loan repayment capacity. Where we have loans outstanding to banks or otherwise, how do we repay the capital associated with that? And those capital repayment schedules are a really important part of that budgeting process. In the longer term, we're concerned about things like asset valuation and asset replacement. We're interested in asset valuation because that helps us to understand how well our balance sheet is growing and how well it's structured in terms of net wealth of the organisation, that is assets minus liabilities. And asset valuation is a really important part of that process. Are the assets that we hold increasing in value? And can we take into consideration those increases in value when we think about ultimately asset replacement? For instance, can we sell one property and buy another property, and what's going to be the variation in cost or the difference between those two conceptions? Asset replacement and asset valuation therefore go together, but asset replacement relates to when we're going to replace assets that are relevant to our operations in order to maintain that operational capacity going forward as well. I've got a screen that we'll look at in a few minutes in relation to asset replacement and some of the decisions that you need to make. The other aspect that we've already talked about is the investment capacity of the organisation to ensure business continuity. Business continuity is probably closest to that definition of sustainability that I gave before, where we're concerned about continuing to be able to meet our mission, provide the services that are required in the right quantity, in the right quality, and in the right timing. So that business continuity, though, can change over time, or rather can be impacted over time as funding arrangements change, as a raft of different things might hit the organisation's capacity, including in relation to the nature of the cohort that it serves and the requirements of that cohort over time as well. Therefore, in the longer term, you do need to be setting aside funds in order to be able to ensure that business continuity and to be able to restructure effectively to be able to meet need as it manifests from time to time in the period heading forward. So the elements of balance sheet budgeting include targets, and I think this is a really important part. And going back to my comments previously where I said it's critical that you don't simply allow the balance sheet to fall out of the budgeting and financial planning process, but you actually create targets around those elements that you think need to be important. I divide these up into two sets of targets. Firstly, the primary targets. And primary targets are things like minimum balance targets. So having so much cash or so much working capital as a minimum requirement in your balance sheet as a really critical set of targets to be able to help you to determine what kind of assumptions you might make in relation to your profit and loss budgeting and also in your cash flow budgeting going forward. I'd also say that ratio targets might be an important part of your balance sheet budgeting process. And I'll talk to this a little bit shortly, but suffice to say at this point, ratios are a really important aspect of the analysis of the sustainability of an organisation, and having ratio targets helps management to be able to focus on the elements that are important to the board in the context of balance sheet budgeting and making sure that the balance sheet is constructed in the right way for the organisation to be sustainable going forward. Again, I'll talk to this shortly, but I think it's important to remember ratio targets are a good primary target in terms of determining how much in terms of assets and how much in terms of liabilities you might want to carry. And then, of course, how do you plan to get to that particular position? And then the final primary target might be the net assets target or net wealth of the organisation, assets minus liabilities. A really important aspect when we think particularly in the longer term and start thinking about the value of assets and the value or the cost of liabilities that might impact your organisation going forward. The other types of targets that I think are important to take into consideration are what we call facilitative targets. Primary targets are really around what your balance sheet needs to look like and then allows you to develop your strategies around how you're going to get there. And even if you're not going to get there, it helps you to and your board to understand what the gap is between what your financial targets are for the balance sheet going forward and what is possible in the current arrangements, which might support advocacy and other activities that you undertake. But facilitative targets are much more specific, and they relate to trying to close the gap between the way the balance sheet is structured today and how you want it to be structured. So for instance, you might take into consideration things like philanthropic donations. You might take into account lottery system applications, and I think charities and not-for-profits around the country are very used to applying to their state lottery system in order to be able to get capital amounts to be able to undertake projects or to be able to replace assets and so on. But other facilitative targets include the profit target. That is, any organisation operating in a market economy, charities and not-for-profit organisations are no different, has to be able to achieve a profit in order to be able to operate sustainably in the longer term. And so the facilitative targets here, the philanthropic donations, the lottery system applications, other applications or processes you might enter into, combined with the profit that you're able to generate, are able to give you a sense of your ability to be able to achieve those targets that we're talking about. Okay. The final element is the net cash flow target. The net cash flow target is really fundamentally important. And I said in the first webinar in this series that cash is king. Without cash, you cannot survive as an organisation in a market economy like Australia. And therefore, one of the key elements is that all of these targets need to then be able to inform your cash flow target and how much cash needs to come in on a weekly, monthly, annual basis to achieve your financial planning targets. Let's just have a look at some of those specifics. So first and foremost, ratio targets. Ratios focus on multiple elements, and that's why I think they're particularly good targets to think about in the context of balance sheet budgeting, because a ratio focuses on or is designed to provide analytical information that helps you to understand the relationships between various numbers as opposed to just simply talking about a number. However, ratios are also arbitrary, and there are a set of commonly used ratios, so working capital ratio, the current ratio, and so on, which many in the audience have probably heard of or have come across before. But they're arbitrary ideas, and so you might, for instance, want to have a ratio developed that is specific to your organisation and the things that you want to focus on, or you might have arbitrary industry level ratios that help you to focus on what needs to be analysed, but don't necessarily give answers or identify what the ultimate problem might be within your organisation. The key value of ratios, though, as I say, is that it focuses on the relationships between different elements in the balance sheet as opposed to focusing on just one element. At the end of the day, it's the relationship between those elements in the balance sheet that determines your sustainability, not the individual elements themselves. So I guess the other element around this is, or the other important aspect of ratios is that they both have a governance focus and a forecasting focus, and I think that's really critical. You can use ratios to understand what's going on or to focus your analytical capacity, but you can also set ratio targets, and boards particularly can do this, that then help to set how an organisation goes forward and helps the board to understand whether or not the organisation is actually succeeding in its financial planning processes. And finally, of course, a ratio can give you support for directional analysis. That is, what kinds of things are going wrong and where do we look? Let's have a look at the working capital ratio as an example. The working capital ratio is designed to give us an understanding of what our current assets are compared to our current liabilities. It helps us understand what our minimum bank balance has to be from time to time to ensure we keep the doors open. Clearly, we want to have a minimum amount of working capital in the business because we tend to view that as unproductive money. It's sitting there against having to pay assets as opposed to sitting there helping us to build the business or to invest or to do other things that we might want to do. And therefore, we might set, as a board, set a target for what our working capital ratio might be. That is, we might have $1 of current assets to every 90 cents of current liabilities or something of that nature. There are many ways to look at this. Why is the working capital ratio considered here? Well, first and foremost, it goes to sustainability and solvency in the short term. But secondly, in order to be able to analyse the working capital ratio, we need to think about a number of different assets: debtor collection, cash balance, uninvoiced income, and also stock turnover. So if you're an organisation that sells things, you need to think about how often your stock turns over. What does that mean? It means that we can have targets for making sure we collect our debtors within a certain time. We can have targets about how much cash we have on balance at a particular time. We can ensure that uninvoiced income is invoiced more quickly so that we can collect it more quickly. And we can also look at our stock turnover and how much money we've got invested in stock in order to be more efficient. That is, to reduce the amount of stock that we might have on hold because it doesn't turn over as quickly as we want it to. So you're already seeing that if we think about the working capital ratio as a ratio target for our balance sheet, then we're starting to see some policy and target outcomes associated with the current assets. Of course, we can have those target outcomes for current liabilities as well. And it won't surprise you to hear me say employee entitlements are one aspect of that. What are they, and how quickly are we expunging those employee entitlements? In other words, how are we managing all of our employees to take their entitlements as soon as possible to reduce the cost to the organisation? Also, how are we ensuring that we're paying our creditors within an appropriate time frame? If you like, you might actually consider this issue as being a fairly major issue, because when organisations become insolvent, one of the very, very early hallmarks of insolvency for organisations is an expansion of the creditor's payment time frame. That is, rather than paying every 14 days or every 30 days, it starts to creep out. And it creeps out because, of course, management is trying to preserve cash that is not coming in. And ultimately, that builds a very significant problem in your balance sheet, as I'm sure many in the audience would recognise. What does that mean then? It means that you need to have targets to ensure your creditor payments, your employee entitlements, and things like unearned income are reduced as far as possible and are controlled and managed as far as possible in order to achieve the working capital ratio you're looking to achieve. So automatically, looking at balance sheet budgeting, looking at working capital ratio, we're already getting a sense of what our policies and processes need to be to have good governance over current assets and current liabilities locked up in that one single ratio. And if we have a ratio target, then management needs to manipulate all of these outcomes in practical terms in order to achieve that particular ratio outcome. Now, we've got time for questions at the end of the presentation, so people might have some questions around this, but I think the example is fairly well put. The other element, of course, is working capital budgeting, and we displayed this particular slide in the last presentation as well, in the last webinar, to show that working capital cycle. We want to reduce the working capital that we hold in the organisation for the reasons I said before, essentially it being a unproductive element. So in the short term, one of the major areas of focus we should have is on that working capital budgeting and what our balance sheet should look like if we are being efficient in terms of the amount of working capital we carry. Therefore, the targets might be based in that ratio, which we talked about before, but also we might reduce the working capital cycle by taking some soundings on how long it takes, for instance, to get debtors to pay. The sooner we get debtors to pay, the less working capital we require in the bank, the more efficient our organisation is and the more sustainable it is. In the medium term, of course, we're concerned about cash levels and reserves. Things like cash backing your employee entitlements, that is holding cash against paying out your employees, which requires you to leave forecast, and it also requires you to make provisions around reinvestment and asset replacement as that becomes important. In the medium term too, profitability is going to impact the capacity of your organisation to maintain solvency. And so margin achievement in the P&L is absolutely critical over the medium term. Incremental reserve building is a really important part of that financial planning process. That is, all of these ideas are designed not to change the balance sheet overnight, but to change the balance sheet over the financial planning period of 3 to 5 years, so that you're in a position to be able to get the balance sheet structured as you want it to be structured in that period of time. Of course, if you're really lucky and there's a great opportunity for you to restructure the balance sheet immediately, is of course absolutely critical if you can do it. But most organisations can't. Most organisations have to build their balance sheet in an incremental fashion. And of course, that allows you to have that governance focus I spoke about before. If you're not achieving those targets in terms of the balance sheet, then how do you ensure that the organisation is being governed properly going forward? The other element that was identified in the longer term is the asset replacement considerations that I mentioned before. And this panel just simply provides you with some considerations around what we might call replacement principles. That is, where assets have an attribute that is listed in the left-hand column, so it might be unserviceable, unreliable. The risk to the organisation manifests if that attribute manifests in itself is described in the middle column, and then the governance process around these issues is described in the third column. The ultimate outcome needs to be that from balance sheet budgeting perspective, we need timelines on all of the assets in the context of these attributes, and then prospective costs, budgeted costs of what will need to be paid to replace those assets at that particular point in time. Finally, and we are moving into question time now, so give it some thought, but finally, in terms of the components of financial plans, I think it's absolutely critical that people consider how these documents, so the budgets, the ongoing financial planning process, so things like asset reinvestment plans, employee entitlement payments estimates, and loan capital repayment estimates, for instance, all join together in order to have an annual update of your financial planning process going forward, including the balance sheet. And this slide, I guess, is intended to give you just some examples of both the kinds of context or documents that might be important, and also what the questions might be that the board, CEO, or others might ask in the context of that financial planning process. Okay, so I'm aware that I've gone just a couple of minutes over. I'm really happy to take questions, but I think I'm going to hand back to Lockie now to be able to do that.
Thank you, David, for that. We do already have a few questions coming through, so we might just get straight into them. The first one is, very detailed income and expenditure are used over both income expenditure statement and cash flow statement. Is a separate cash flow statement necessary for a not-for-profit organisation?
Look, these things, so I'm obviously speaking at a very general level and not providing advice, I guess, is the first thing to be aware of. The second is, of course, that speaking at a general level, I don't know different organisations' particularities or peculiarities or capacities. But what I would say is that if you're a really small not-for-profit or charity and you lack resources, either in terms of actual people with accounting background or the time for those people to be able to undertake extensive budgeting processes, I'd put to you actually that your cash flow budget is probably more important than any other budget, because your cash flow budget is what we use to determine whether or not we're solvent in the first instance. So yes, the short answer is I think cash flow budgets are critical regardless, because cash is king. Without cash, you're not going to get to the medium or longer term. But you might, if you're a small organisation with limited resources, choose to prioritise the cash flow budget amongst other budget processes.
That's fantastic. Thanks, David. I should just note to everyone, if you do have any questions, feel free to send them through. You could do that through the questions or the chat tab on your GoToWebinar control panel, and they'll come through to me. Our next question is, what elements need to be considered to calculate a good minimum balance target?
Yeah, that's a really, really significant issue. So first and foremost, without being able to say to you categorically it's this or it's that, you need to, I think, do three things. First and foremost, you need to understand your balance sheet. You might recall in the last webinar, or you might go back and look at the last webinar if you haven't looked at it already, but I spoke to a number of issues around understanding not-for-profit and charity balance sheets. One of those issues is in terms of the nature of the assets that you might have, and I termed those controlled or administered assets. Some assets that not-for-profits and charities hold are assets that they can do whatever they like with. They've got complete proprietary over. In other words, they can sell them, they can deploy them, they can not use them, whatever they want to do. But of course, charities and not-for-profits also have assets that are administered. And those assets are the kinds of assets that you receive from philanthropists or from lottery systems or elsewise, perhaps from the government, or you receive the money to buy those assets from those sources, but they come with significant caveats applied. In other words, it might be that you're not allowed to sell the asset for 10 years. It might be that you have to use the asset for that particular service. Those of you in the audience that have been involved in aged care, for instance, might recall the Commonwealth HACK program some years ago, that HACK would buy assets for your use in delivering that program. But if you didn't deliver that program anymore, you had to either hand that asset back to the Commonwealth, or you had to hand it on to another HACK funded provider approved by the Commonwealth. In other words, the balance sheet can be, if you don't understand it, it can be misrepresentative. And a lot of to be honest, a lot of commercial people and commercial auditors fall into the trap of thinking that administered assets are able to go into, for instance, your sustainability or solvency calculations, where in fact you don't have the right to sell those assets, you don't have the right to use them sometimes for other things, or at least for a period of 10 years. So I think getting to know your balance sheet is really critical. The second element is, once you've got to know your balance sheet, being able to take out those accounting adjustments that are really important, and being able to focus on what we might term the cash impact adjustments, or the cash impact elements. Things like employee entitlements are really critical for not-for-profits, but so too is asset replacement and the extent to which your assets are going to be able to be functional and serviceable over a long period of time. Which gets me into the third element. When we start to look at those assets, I think it's critical for CEOs and directors to really understand the nature of the assets that they have, what kinds of things might impact their sustainability going forward. That is, how do they contribute to the organisation's mission, and what happens if they don't contribute any longer because they break down, they become irrelevant, or whatever it happens to be, and what the timing of that might be is a really critical aspect as well. So I think they're the three fundamental things that need to be understood. But you might also, for instance, have shares that you might hold as an organisation, and so you might consider what you're going to use some of those kinds of investments for over time, and how you might use those in terms of asset replacement or whatever it happens to be.
Great, thanks, David. And while you were answering that question, you mentioned the previous webinar in this series. I'll be sending out a link to watch that to everyone who has registered for today's webinar, along with the slides for today's webinar, and any other information on the not-for-profit balance sheet. That's actually all we have time for today, as we've ticked over 1:40. So I'd just like to thank you, David, for your time and your insights. It's very valuable, and I'm sure our members are very appreciative as well. On behalf of our community and CommBank, thank you to everyone who attended today's webinar. It was really good to see you all here again, and I will send out information when we have it ready for the next webinar in this series. Just a reminder, it would be great if you could please fill in the survey so that we can use the information that we get from that to better tailor our future courses. But for now, it's thank you, and enjoy the rest of your day.
Thanks very much for the opportunity. I appreciate it. Cheers.